Welcome back to Echo Trade. Today we have a new partner firm on with us, Wisconsin Capital. We've got a father-son team of Nathan and Tom Plumb. We're excited to have you guys on board and talk about the new portfolio. So Tom, Nathan, appreciate you being here.
Thanks. Great to be here, Jeff.
Yeah, excited to partner up. So we're going to jump into it. We're talking about the Plumb Growth Industrial 5.0 portfolio that's now available on Echo Trade. And I want to dive into the name, like Industrial 5.0, what we're talking about. There's a little bit of a story behind that, and kind of we'll probably talk a little bit about how you guys are invested and what's the purpose of the portfolio. So dive into that. Where does the naming structure, what does Industrial 5.0 kind of reference within the portfolio?
Yeah, we believe that we're in the midst of a new industrial revolution, and this new industrial revolution has been coined 5.0 in 2023. I forget the offer right offhand. It's kind of a play off Industrial 4.0, which was done by Klaus Schwab in 2006. Essentially, it's showing the convergence of all these different fields to make the world better. So you see all these interactions of bioscience, material science, all these are just having, each area is having an incredible renaissance within its own field. Of course, to add in artificial intelligence and that revolution, they kind of recoined it in 2023 as the Industrial Revolution 5.0. And that's what we're really believe in and strong advocates in. And we believe that this is a secular trend. A secular trend, macro secular trend that is it's just going to lift all boats, and these type of companies are going to outperform some of the traditional companies, and have the added effect of actually helping companies that you wouldn't think of being AI related to help those really boost their productivity and just make the world more efficient and just have enough onto the next discovery after discovery.
So this is really kind of and forgive me for putting words in your mouth, the tech focused type of portfolio that's really kind of looking to capitalize on those companies that are driving that next generation, the 5.0 generation of this, kind of new industrial revolution. Is that what you're saying?
That is correct. So each field is having its own amazing revolution with itself. So when you're talking about blockchain technology, they completely revolutionized companies like Visa and MasterCard, which you usually don't associate with those things, and completely transformed those businesses. And we're advocates and obviously investors of both those companies.
Nice. So can you give me
go ahead, Tom. The times when you have a new industrial revolution that changes how everything is done in an economy. And it's in ways that would be unforeseen before. But the industrial revolution, the ability for just, even if they think about in our country 150 years ago, we were primarily farmers. And now we are city urban dwellers. Our job descriptions are completely different than what they would have been last cycle. The data revolution that we started to see in 2006 just paved the way for this next generation of change that is so dynamic that you want to participate in it. And we always feel you need to participate with the innovators, the executors, and the benefactors of a change, especially if you can identify a secular change. I think then you look at how you're going to play that for multiple years.
Yeah, it's interesting. Like you mentioned, and Nate, you mentioned that as well, where you mentioned companies like legacy blue chip companies like Visa, where you're not necessarily, and you might also be invested in open AI or some of these other kind of startup, AI companies or blockchain investments, but you're also looking at legacy firms that are capitalizing and benefiting on the new technology.
That's exactly right.
Yeah.
And these companies that are the leaders have the cash flow, if they execute, to continue to be leaders.
Yeah. And so talk about, kind of have an idea of the broader ecosystem of companies that you're looking to invest in. What does the process look like to kind of identify those companies, kind of where you invested, what what's the investment analysis process to kind of funnel down in the broader ecosystem of stocks to be able to, what are you guys going to put into the portfolio, and how often you guys, changing that up and kind of rebalancing or looking to make changes within the portfolio?
Yeah. So I think you can invest in about 60,000 publicly traded stocks. So we have a very large universe to choose from. We don't really have like a defined screening process like a lot of firms do. We kind of sift and winnow down. We get to about 400 or so that get the characteristics that we're kind of looking for. And then we really aggressively, listen to all the conference calls, look at their presentations, look at the, do a financial analysis on that. And through sifting and winnowing, you get it down to about roughly about 35 companies, the ones that are actually the ones that you choose. And then from there, the key of a outperforming portfolio is to actually get the weightings right in those companies. And so after you pick the top 30, 35 companies, you have to decide, which ones are going to be your largest holdings and which one are going to be smallest holdings, and try to, moderate the volatility between that portfolio. There's a common misconception in this industry about diversification. It's very overused. You are essentially, if you pick about roughly 20 S&P 500 stocks, you're going to perform a lot like the index. So I find that people kind of use diversification as a crutch just to say that they really don't know what they're investing in. So here we're hyper focused. We know exactly the companies that you're invested in. We know them inside and out. If we have a change of thesis, then we sell. As I said, there's 60,000 other companies out there that we can look for. You can't get emotionally tied to a stock. And then obviously we have some that are, the 35 through 40 that we're looking for, essentially, like, to use a baseball analogy, like an on-deck circle, and then we can add those in. So we really don't have an emotional attachment to the stocks. We're just looking for holdings that will outperform. Our time horizon is longer than most investors, and we feel that is an advantage. So some people, use candlestick charts and are trading by day. Some people, industry standard is usually people are looking quarterly. Our advantage is that we're kind of looking, what does this company look like 3 or 5 years out? And often if our thesis holds, we're holding a company that long. And so not only do we feel we have a research advantage, but we also have a time horizon advantage.
Yeah, last December, Jeff, I was on Bloomberg Radio, and they asked me about the timing on NVIDIA. And I said, NVIDIA, you don't time NVIDIA. You are either invested in it because you can see and believe in the delivery of what they're offering, what the advantages are, how they're leading in the economy, how they're leading in the industry, how they're partnering, how they've basically developed, like Apple did 20 years ago, software-enabled technology and embedded it into our daily lives. And but they're not a trading vehicle, So when we go on and they ask Nate, what do you think will happen to NVIDIA after they report their earnings in February, such and such? We say it'll probably go up or down a lot.
Yeah, you see the options like, well, it's going to probably go 11% up or 11% down from how but from a long-term perspective, like, that quarterly is kind of like noise. Like, do you see the secular trend where they're going? And we obviously believe that story. That's our largest holding. But we're not trading in and out by the quarter because we have a long-term view of NVIDIA. They won't hold their advantage forever. Nothing happens perpetuity. So their competitors are strong, and obviously want to catch up. But right now NVIDIA is ahead, and they're holding that lead.
Yeah, it sounds like you guys take a kind of like you mentioned, a secular or kind of thematic approach on a broader kind of category that you guys have, are optimistic about, like whether AI, blockchain, et cetera, these industrial revolution 5.0 types of companies. And then you're looking at a, more kind of bottom up individual company basis and see what their competitive advantages are. But like you said, you have a longer term vision on that. So it depends on what the investors' kind of goals are, that might fit better with them, and be patient and through further market cycles. And you can kind of see how the portfolio might outperform. But again, to your point, you don't have an emotional attachment. So you can have a 3 to 5 year time horizon, but if things change, I'd imagine you guys are able to, get out of that position if your thesis no longer holds.
Yep.
And we have to, just a few years ago, a company called Biomed was our largest holding. 12 months, it was the best performing stock in the S&P 500. But when there had some adoption issues, we sold the whole position immediately within a week or two of our determination that they were not going to be, meeting our expectations.
Yeah. And I think it's so valuable, like with what we're doing with EchoTrade, to be able to kind of give access to investors, to guys like you that do this professionally, to be able to have that non-emotional attachment to a holding, because that's hard to do as an individual investor, especially if you have such conviction and then the things change, to be able to make that decision and remove that and put something new in the portfolio. Talk about that a little bit more in terms of kind of how you guys are managing risk. How do you guys look at this from a risk profile, aggressive to conservative, et cetera? And what are the things that you guys really do to kind of make sure you're mitigating that risk, on a short-term and long-term basis?
Can I start that and you finish? So one thing we do as professional investors is that you often, as a person, you hear about top-down investing. You talk about the thematic things that we just been mentioning.
Yep.
But also there's a fundamental analysis. So you have to look at the numbers and see if this company is correct. So we are interweaving the two like a mosaic. And so because to have those two things are really advantageous for you. So it's easy to find companies that, have great stories, but no fundamentals. I think you mentioned a couple of them in the beginning. It's also, you could look at really cheap stocks that really, it's hard to find a cast and see what was going. And having that blended analysis, we feel is a huge advantage, because we don't think a lot of people think both ways, and we do.
And obviously, you're in a macro environment and you have to have some assessment of that. But we also know that most economists, most strategists, they revise their estimates multiple times a year, and there's no consequence to them for doing that. For us, if we're wrong, we sell. We don't have to, we don't modify a little bit of a change and say that, well, we are right because we changed our opinion yesterday and things like that. So we have an environment we're in, and we often find that a lot of the speculation and the trading aspects of that, like interest rates, what the Fed might do, what they might do 6 months from now, those types of things, we think we have to put them into a parameter, a box, understand what the consequences would be in different directions, and be relatively neutral as to whether or not we think certain parts of those expectations will come through. But we've been amazed after all these years how you still have knee-jerk reactions to things that really don't impact. A year ago, people were concerned because we had a yield curve that was showing higher interest rates going down, so that was supposed to signal a recession.
Yeah. Inverted yield curve, always a recession was the narrative.
That was the knee jerk, and then they started to lower rates, and now 5 year, 10 years are a little bit higher than the money market rates or the treasury bill rates. And they start talking about that's negative because, the rates haven't come down everywhere. A lot of it is noise. And we think we've been able to siphon through a lot of that noise to get to the core characteristics that are going to actually impact our portfolio. Then within that, as Nathan pointed out, you can suggest that this company is well positioned. They have a great strategy, a philosophy. They have to execute. And that's what we're looking for on the quarterly reports. Are they executing in a way that allows you to think there's a sustainable advantage that they're building on? Or is it something where they're having some challenges that are going to prevent them from being the company that you were hoping or expecting to be 2 or 3 years from now. So
Yeah.
we watch that very closely, and we put it into that mosaic that Nathan was talking about, and we are comfortable with that. I think the other point is, we almost never have more than 35 stocks. And some of those stocks we might be cutting back, some we might be eliminating, some we're starting. But we have a core area of about 20 stocks that are probably 80% plus of the portfolio. And that's because we do the work that we can have the conviction.
Yeah, you have high conviction on a concentrated portfolio. I think that's what is it, a Munger? I can be high conviction on 3 stocks. I don't care if I have 100 in there. If I don't know what the hell's going on with them, then who cares?
Right.
And I like your approach as well. You guys kind of approach it a little bit differently than I historically do. I like to look at the charts and the candlestick charts like you were mentioning, Nathan. But like you mentioned, the shorter term you get, and from a fundamental perspective, when you're thinking about earnings report and what the Fed meeting had, what Powell said this day or that day. There's a lot of noise there. And I always looked at it, when you get the day traders, the shorter that are looking at charts, the shorter the time frame, the more noise and the more difficult it is to be able to kind of actually look at what the indicators that you can rely on. The longer the time frame, it evens out, and it's a lot easier to make good decisions on that front as well as on the fundamental perspective from where you guys are kind of looking. So no, I appreciate it. Love the conversation. I'm excited to have the portfolio on Echo Trade. Investors be able to get access, and yeah, they can take a look at it on echotrading.com and learn more about Tom and Nathan. And we're excited to partner up with you guys, and can't wait to see what the next couple of years hold.
Yeah, we're excited to be a part of it with you, Jeff. Thanks.
All right. Thanks, guys. Appreciate it.